Well, it's good to be back. This is a new building that wasn't there when I was here. Graduated in '89. Those days, the most popular job when I graduated was either consulting or investment banking. And private equity in those days was not that well known. Today, everybody knows about private equity mainly because of some of the big deals they did, like Burger King, Toys R Us, and you name it, Freescale. Some of the companies they bought touched our everyday lives. And also because a lot of people, very interesting and famous people who leave their previous jobs, go into private equity. Jack Welch, even Colin Powell. He is now advisor to a venture capital firm in the Silicon Valley. And you read about these guys every day. In China, same thing. A lot of people get into the industry. So I think I'd like to talk, instead of giving you cases, formulas, or techniques, which in my days as a student I thought was very boring. I would hide in the back row and take a little nap. So instead of doing that, I thought I'd just tell you the things I've learned as a private equity investor over 20 years, since the days after my graduation. And I want to talk about the things that are very hard to manage. And I'll give you a lot of examples, maybe too much in one day, but these are real-life examples that I have lived through in my career. And as they say, you can never make enough mistakes in your lifetime. So I hope some of the mistakes I've made as an investor would serve as lessons for you as well. So first topic, hardest things to get right. I think these are the four things that are toughest. Obviously, the first question is whether you invest or not in a company when you've presented with the opportunity. Second is, if you decide to invest in it, what kind of structure, how much to pay for it, how to negotiate to get what you want, because it's never easy to negotiate a great transaction. And once the deal is done, you're set. It's very difficult to change the economics of a transaction once it's negotiated and signed. Dealing with management is very important. Your die is essentially cast in a business if you invest in a business. I remember a very interesting saying, capital seeks ideas. It does not create ideas. So we are managers of capital entrusted to us by investors, but we cannot create ideas. We have to find the people who have the ideas, people like the inventors of search tools like Google, MySpace, Facebook. These are inventors. So there may be dropouts from Harvard University or elsewhere, but they create the idea. They come to us for financing. Then we provide the tools of financial support and capital market access to make their dreams come true. The last one, I think, is the hardest one, is selling at the right time. Whether it's selling into an IPO, selling into a multinational, or pulling the life support cord from a sick company once you know it's terminally ill. This obviously is the hardest question. Why is it hard? Because there are many, many variables. And Bulent asked me to talk about the difference between international private equity investing and investing in the US. The top one says it, political stability. You don't have to worry about the current government, the Obama government, being toppled by some coup in the US. You don't have to worry about the US currency because you're in the country. You don't have to worry about capital markets going upside down because of some turmoil like 1997, the financial crisis in Indonesia. We invested in a bank called Bank Tiara, which is a private bank, the most profitable private bank in Indonesia. Financial crisis hit, 200 banks in Indonesia overnight became 3 because the government decided to save these 3 national banks. Everybody else was just gone. And the Indonesia rupiah went from something like 3,000 to the US dollar to 9,000, 10,000, 14,000. The company was just gone, disappeared. Couldn't find a trace of it. I went back to a few years later to find the family that owned the bank. It was just painful to see them. White hair, stooped down. Very, very sad because it's a macro event that we had to pay attention to. If you had invested in Bear Stearns, Lehman Brothers, prior to the financial crisis, tough luck. It's a seismic event that changed the economy, changed the industry. So macro, we think, is bigger than micro. Micro meaning pick which companies to invest in. Macro means transformational events, dislocations that will create or destroy businesses. We have to pay attention to that. Otherwise, your history. For example, if you invested in a newspaper business a few years ago, now you're toast. Why? Newspapers depend on advertising revenue for support. That's how they live. I was yesterday having dinner with a lawyer. He told me he was handling the case of bankruptcy for the Philadelphia Daily News. It's gone. You know why? Advertising, nobody looks for jobs from newspapers, pages anymore. Nobody advertises for apartments. No, nobody, very few people. You do online searches. That business model is gone. People get their news from internet, right? So it's very important to always bear in mind what industry trends, what macro trends you're dealing with. And then emerging markets, you have government intervention. You have legal framework issues. One example, 2008, Warburg Pincus had an investment in Huiyan Juice, which is the largest juice maker in China. I was the director. And we struck a deal to sell the company to Coca-Cola for $2.3 billion. If the deal went through, it would have been the largest foreign acquisition of a Chinese company in China. The Chinese government denied the deal, denied our chance to sell the company on antitrust grounds. That's government intervention. In China, you have to think about it. We announced the deal. Both companies, actually, the deal involved 3 listed companies. Coca-Cola listed in the US, Huiyan Juice listed in Hong Kong, 20% shareholder Danone listed in France. Everybody approved the deal. All the shareholders went through their shareholder vote, board approval, done deal. Only subject to government approval. Chinese government said no deal. After 6 months. So shareholders lost money. The stock went from $3 pre-announcement to $12 post-announcement, back down to $4 a share. So that's what you have to worry about in countries like China, India, Brazil, Mexico, emerging markets. Business model, that's another thing you have to think about. Why do I say business model? When you look at investment, your firm's own business model plays a role. For example, if you're a VC firm, you don't want to invest all your fund, whether it's $200 million fund or $800 million fund, in one deal, because the VC model is putting a lot of smaller investments, $1 million, $5 million, into many, many ideas, hoping one of them, maybe 5 of them, will become a Google, the next MySpace, Facebook. So that's the business model of venture capital investment. The other thing that's different is most of the buyouts are done in one shot. You go to Toys R Us, you say, okay, buy you out tomorrow. You pay $10 billion, deal done. VC investments phase in over time. That's A round, B round, C round, D round. You know why? Because these companies are new companies, early stage companies. They need to achieve milestones. They need to see progress. And if you put too much money all at once in the very beginning, the risk is too high. The entrepreneur is like a kid in a candy shop. Oh, I have all this money. Let me invest it all. So they spend it, they splurge it, and then they come back to say, sorry, investor, I'm out of money. Can you give me more? Then you ask them, where are your achievements? So after 40 years, Silicon Valley has developed a model where you finance the investor, you spoon feed them, step by step, as opposed to giving them money all at once. Buyouts, no way. You go to Toys R Us and you say, can I pay you 20% today and another 20% next year? Not possible because you're buying control. So when you face with an investment, you have to think about what you're good at. In the 1999 to 2000 framework, VCs were having a ton of successes. They were selling companies. They were getting outsized returns. A lot of private equity guys, even KKR, wanted to get into VC. They failed. They came back to their roots. Similarly, private equity had a ton of success in the 1990s because leverage was available, debt was cheap, and many VC companies said, "Ooh, let's raise big funds." So instead of raising $200 million funds, which are perfect for the VC model, they raise big funds, $800 million, $1.5 billion. Last few years, you know what they did? Return the money because they could not invest the money. Business model issue. They could not find entrepreneurial companies where you could invest 20, 50, 60, $100 million all at once. Micro issue. In the sector selection and investment thesis. In private equity, it's not like throwing darts. You have to have a thesis. Why this investment makes sense? Why you pick this company? Why at this time? Why at this valuation? Percentage of ownership. In emerging markets, it's like US at the turn of the century. You went to JP Morgan, John D. Rockefeller. He said, "Mr. Rockefeller, can I buy you out for this amount?" He says, "I'm doing very well. Why do I need you to buy me out?" So it's true today in India or China, well-run businesses, they don't want to sell control. So it's impossible to use the US model in China, India, to buy out businesses that are growing fast, managed well. They only need a little bit of push in terms of growth capital as opposed to buying out. So you have to think about your percentage of ownership. In an entrepreneurial company, if you become, you being the investor, become the largest investor with control, you demoralize the original entrepreneur. They lose the incentive to work hard because they feel like instead of feeling like an owner, they become an employee. It's no different than working in GE or at GM. So we have to make sure they have enough at stake to incentivize them to continue to feel passionate about their businesses. Management quality, very important. We think management is key in every single investment. We've actually looked back at the history of the firm. In 40 years, we've never had a deal fail because we paid too much. Most of the time, instead, a deal failed because management did not deliver. They had this problem, they had that problem, they had hubris. They got overexcited over some expansion, bought a company. More companies fail because bad acquisitions than because of their own organic growth. Then you talk about deal specifics, deal structure, and so on and so forth. There are so many variables that you have to consider. That makes the question of investing or not investing the most important consideration. And that's why most private equity firms have investment committees. And they want you to come up with a thesis. They want to prove it. They want you to debate and defend your thesis. I think personally, if you synthesize the success factors, what we call key drivers for success, you can look at three different things. One is when you have a business model, new business model, like online gaming, like search that never existed before. And then these things go in waves. If you capture the right wave at the right time, you will be successful. Computerization, like you first had the IBM, then you had Microsoft, and then you had Apple, that whole wave. Building computers in Taiwan and all kinds of electronic gadgets, you catch that wave first. Then you had the 1970s VC success. Then you had biotech revolution. You capture that, you're in business. The next one is telecom, from old fixed line telephone to wireless, to broadband, to internet, to ADSL, to all kinds of things. If you capture that, you're in the telecom and optical equipment. In that business, you supply the tools and the equipment for the information superhighway. You call that wave. And then it's the internet, obviously. And then you have social networks, online gaming, and outdoor advertising. The list goes on. Anyway, these new business models appear every day, and it is the job of the investor to identify these new business models and try to find the investors that will take your money and bet on it. Then you have to anticipate the powerful trends. For example, in China, when we started first in 1995, it's a big country. You go in there, so what should I invest in? Imagine yourself as an investor walking in with $1 billion under management. What do? You buy power, you buy railroads, you buy highways. What do you buy? It's a big, big question because it's a blank sheet of paper. Very different from investment banking, where you have targeted audience. You have targets. For example, investment banking, it's very easy to identify which companies want to go public. You just go to them and market them, your service to them. Consulting is also relatively easy. You identify the biggest companies in the industry. You say, okay, let me help you rationalize your business, become number one. Private equity, however, has no targets. You go into a country or industry, it's all your call. So that's why it's hard, because you sit there, you take a piece of paper and you say, okay, map it out. So when I started at Warburg Pincus in 1995, I was the first Chinese hired, and there was no Chinese employee. We had no China operation. I had to first come up with a name for Warburg Pincus in China, then decide what to do. So what I did was I worked with McKinsey and the economists at different places, come up with what I call 10 mega trends. Those are the trends that will shape the country and the society in the next 20 years. I think that these 10 megatrends would influence a lot of things and have investment implications. For example, just take you through maybe two trends of the 10. Urbanization, it's an overriding trend. 30 to 40% of the 1.3 billion people live in the cities. The rest are in rural areas. Over the next 50 years, the majority of them will move to cities. The US, for example, the urban population is 96%. So if you do the math, 20 million people a year move into new cities. And these cities are going to be gigantic. Today, there are 125 cities in China with 5 million people or more. And you think about all these people moving to cities, what do they need? Housing, building materials, shopping, entertainment, restaurants. And you think, okay, how do we take advantage of that? You invest in home builders, invest in building materials, cement, and then you invest in consumer products companies as well as retail. So that's a big one. The next one is when people get richer, they will want better healthcare. They want to spend money not just on food, but also on healthcare. So drugs, hospitals, clinical services, and so on. So these mega trends will influence a whole generation of companies that will need capital to grow, and they will grow faster than the others. And that's how private equity makes money. There are 4 ways to make money in private equity. Investing in growth, assuming going and coming out at the same valuation. The growth rate and the ROE is your return on capital. That's your IRR. Next one, buy low, sell high, assuming you can arbitrage. Well, you know this company is trading at 10 times PE. Next year, it's going to trade at 20 times PE. You make the difference. Or you can be a turnaround specialist like Cerberus that bought Chrysler, and hoping that they can profit from the turnaround of Chrysler. Obviously, things went the other way, too bad. Didn't work. Then the last one is leverage. When things are not growing that fast, they're kind of steady, 2%, 3% a year, you borrow a lot of money, which is tax deductible. That's how you make money. One of the 4 ways. But in growth and in seizing these trends, like in China, consumerism, or India investing into IT outsourcing, you go into supercharged growth mode, and then you can come out ahead of the market. It's all about beating the market averages. Our investors are the largest pension funds in the world. They want you to beat the S&P by 100%, 1,000 basis points. That's the bogey that you have to get. In order to do that, you have to do one of the 4 things that I mentioned, and you have to invest in some of these big trends like solar, alternative energy ahead of the wave. Or you find a big dislocation, like the financial crisis in Asia, or just last year when the US went into a tailspin, you invested almost in anything, you would have made money. This is the part that's like playing golf. You get a birdie, you want to come back. This is the best part of our business. I love this part. Why? Because it's creative. I was in investment banking from 1992 to 1995 at Goldman Sachs. One reason I left investment banking is it became monotonous. It was not interesting because it's a cookie-cutter business. You go to a company, you write the prospectus, you sell the stock, you move on. You do the same thing again. There's no creativity except in M&A. M&A, there's a poison pill, there's a bear hug, a lot of interesting things, but not everybody can work in M&A. Private equity is M&A times 2, because in every single deal, maybe 3, every single deal, you at least buy once, you sell once. That's both, it's M&A, and you're in the driver's seat. In the middle, during your investment, you could be buying companies, you could be selling businesses, you could be divesting things. So that's why I think private equity is the best job in the world. I'm biased, obviously, at least in the finance world. But structuring and the negotiation is the most creative part of private equity because you're playing with human minds. You're playing with people on the other side. And valuation usually is a zero-sum game. If a company is doing very well, you go in and say, okay, I want to own 40%, maybe 50% of your company. And they will say, how much do you want to pay? Now, you can do all the analysis in the world that you want to do. If the other side doesn't agree, too bad. No deal. And I'll give you an example. The other one is obviously control, negative control. How do you get control if the other guy doesn't want you to get control? But as an investor, you have fiduciary responsibility to prevent bad things from happening. If you only own 25%, what do you do? How do you make sure you have enough influence on the board? That's what we call negative control. Structuring for downside protection. Not everything will go swimmingly well all the time. What if some bad things happen? And you have no protection. You're in common equity. You die as the other guy dies, but too bad the entrepreneur oftentimes will have no money in the game. All they have lost is time. Let's say I have a business plan. I come to you. I say, you give me $6 million for 80%. I put up my life for 20%. 5 years later, I achieved nothing. You lost $6 million. I only lost 5 years of time. Maybe I can still find a job somewhere else. So how do you protect against that? In techniques, obviously, Professor Gorkin will tell you, you can structure liquidation preference. If you sell the business, you take your $6 million first rather than pro rata. But that's the interesting part of our business. One case in point, Asia Info, it's a software system integration company that approached me in 1996. It was high growth, but they wanted a lot of money in terms of valuation. They wanted to value the company at $90 million, but they couldn't even produce a model. So I said, how do you justify this? They said, oh, all I know is that we are profitable. We have more money in the bank at the end of the month than we did at the beginning of the month. That's how we know we are profitable. And don't ask me why or how, because we don't have a CFO. So we send a young guy into the company to help them come up with a model. The model showed that it will be a Herculean effort for them to get the net profit from $1 million to $9 million that they projected. Initially, they projected $30 million. When we did the model, they said, no, we'll probably produce $10 million. And then it became $9 million. So we proposed, okay, based on our work, we said, okay, maybe $30 to $50 million tops in terms of valuation. They said, no, it's $90 million. We think it's worth a lot. Remember, this is just before the internet boom, and the company was very, very hot. A lot of companies were chasing, investors were chasing the company. There was a direct competitor that offered $90 million, no questions asked. But the entrepreneurs wanted us. They wanted somebody who understood China and the internet and technology. So we got into a room. The three founders said, nobody gets out of the room until we have a deal. These guys are all US educated. They all just came back from the US. And in fact, one of them just came back from San Francisco. He would nod off during the negotiation. And then he would wake up, and he would take over the negotiation with me and the other guy. So these three guys took turns negotiating with me, trying to persuade me to accept their $90 million valuation. And in the end, to cut a long story short, I proposed something. I said, okay, you guys insist on 90 million. I insist on 30 million. What do we do? Let's do this. If you can achieve $9 million of net income, we go with your valuation. For every $200 million shortfall, we cut back valuation in lockstep. This is what we call a ratchet. A ratchet is a step down in valuation that is key to your achievement in net income. That's how you ask them to put the money where their mouth is. That mechanism now is very common in China. You see almost at least half of the deals have that feature. But when I first came up with the structure, our partners in New York didn't like it. They said if they fail to achieve the net income they projected, you get a bad company times 2. If it does well, you don't get the valuation you want. But that's the reality. Unless you do that, the ratchet, you won't have the deal. So this is the result. Instead of to prevent people from manipulating results for 1 year, we stretch it to 2 years. So it's average 2-year performance, key to valuation, not 1 year, because you can move revenue or profit from 1 year to another. And then we did the investment for $18 million. What happened? Company did very well, but they failed to achieve their financial target by a mile. So we adjusted, took the company public in 2000. In fact, it's March 20th, just before the internet crash. And the company became very, very profitable and big market cap. At the peak, it was $4 billion. When they went public, it was only $1 billion. But we did adjust our cost from $7 a share down to $1.97. The story will continue with the selling part. Huiyan Juice, terrific company, great market position, a ton of investors interested in the company. And they needed to get the money for pre-IPO restructuring. Company was so hot that we had over 10 bidders, 3 of which wired the money, $50 million, I'm not joking, into the company's account. No due diligence, no negotiation, no documentation. Basically said, keep the money there until the lead investor shows up, and we will go with their terms, no questions asked. So with that kind of competition, what did we do? We had to beat people who wanted to only invest into the IPO with a discount, hoping to profit from it. It was only like 8 months before the projected IPO time. So we offered a deal that was a convertible preferred stock with a pick or cash at our choice with a coupon, but that would survive the IPO, which means if the IPO happens, we still stay in that for 5 years. We stay in the convertible position, our decision to when we want to convert. Because once you convert, you lose the protection. And we also got we got a guaranteed return from the shareholders, so that the majority shareholder would guarantee us 15% no matter what. If the stock goes down, too bad. He still has to guarantee us, because he was supremely confident that he would have success. So it's a complicated structure. We also got a little bit of a protection from Danone, what we called a disaster put. So if the company's operations went through the crack, we could put out our shares to the to Danone, and they had a call option on our stock. So we designed this in a very elaborate way to protect the downside. The company, by the way, the company went public at the top of the market. Our cost was $4.50 a share. The company went public at $6.50, and the stock went up to $9 a share. And then it dropped down to $3 a share because the financial performance was not there. We announced the deal by selling to the company. We ran a limited auction, and I was the one negotiating with them, with advisors, Goldman Sachs. And we had only 2 US bidders, red and blue. You know who they are. And blue dropped out. Red offered $12 a share compared to $3 a share. And then the deal got, as I told the story, got shot down by the Chinese government. The stock went back down to $4 a share. We, however, had the protection from the majority shareholder. So we got our 15%. Little brand. This is an investment I made, one of the earliest investments I made at the company at Warburg in 1997. It was a very good company, crown jewel in the retail empire in Korea, built by a devout Christian who was very interesting, had a fascination with Western culture. He had 6 brands. They were all English names in Korea. Little brand is the short name for Little Brentano, but it's in Korean. And they had very good financials, but the parent company borrowed too much money. The problem got created when they borrowed $90 million to build a golf course. And that's the problem with Asian entrepreneurs. When they get successful, they want to own their own golf course or mountain resort. They needed financing, and we saw the fundamentals of the business being very good, but we wanted to protect against the downside. So we invested in a preferred, a participating convertible preferred stock. Participating means that even though we're convertible preferred, when this common stock pays dividend, we want to double dip. So we get both the 8% PIK. PIK is a very, very punishing instrument because you get paid in kind. So what happened was we invested at a certain valuation, like in $30 million in this case, and every year we get more stock or cash at our option. We pick the stock option, so you actually get the cheap stock every year at the same valuation back, even a few years down the road, you use that. So that's why our initial ownership went from 46% to 56% because of the PIK. And it was an instrument that was very interesting. A few years later, they were very much concerned about control. So this is a company that was founded by this Korean entrepreneur that didn't want to sell. So on the eve of their agreement with us, the management team got together in the room, talked until dawn. They hugged and they cried collectively because they thought they would lose control. So what we did was we went back to them and we said, okay, let's separate economic interests from voting control. We will not get voting rights beyond 49%, which proved actually to be a bad deal because later when we try to go public, they would veto it. We had a 5-person board and they had 3 people including the CEO, we had 2 people because of 49%. So for several times, we voted to go public. We wanted to go public. We would have made 7 or 8 times our money if we went public. But they were afraid that the 49%, the 51% was too delicate. And if we went public, some guy would acquire more shares and they would lose control. So they vetoed it every single time. So in the end, we wanted to get out. The only weapon we had was the 56%. If we keep it going, every year the clock was ticking. And by my calculation, if we went for another couple of years, we would own 70% of the company. So they had to find a solution, get us out. Otherwise, they would be toast. So that's the dynamic. Unfortunately, it is a zero-sum game. Your gain is the other guy's loss. But as investors, we have to structure for our own protection. So the story did have a happy ending. Because the company was so cash generative, they were able to borrow bank loans to buy us out. We made less money as we otherwise would have, but at least we had something like 40% IR. Gourmet, largest electronics retailer in China, about last year, $7 billion in sales, extremely profitable. This is the Best Buy of China. We saw the stock trading at below market, $3 a share, Hong Kong dollars. We felt there was something wrong because the market didn't understand them. They went public through a backdoor listing, not front door listing. And we went to them. We felt that the company was not leveraged. But a big company like this, remember the 4 ways you can make money as a private equity investor, leverage is another one. This company was growing less than the market, but we felt that the stock probably did not have the potential to go 5 times. But if you could leverage it, even if the stock only doubled, you would make 3.5 times your money because of the leverage. So what we did was we bought an instrument of $150 million of convertible debt, CB, 5 years, and we got some additional warrants to supercharge returns. And we turned around. We borrowed money. We borrowed $104 million to limit our initial investment to only $37 million, which was mainly used to fund the interest rate differential. What we did was we sold the fixed income portion to the banks, which wanted to get, instead of getting 3% from LIBOR, they would have gotten 7 or 8% from our investment. What we did, but the interest differential on the 1.5%, we had to fund it up front. So that's why we put up this was essentially the option value. And this way, if we lose money, we can walk away. It's $37 million instead of $150 million. If we make money, the break point, you can chart the break-even point. You can actually make supercharged return. That's why this is a very clever structure that we're proud of. That's very, very interesting. This is a technical point. I don't want to go through it. It's the advantages and disadvantages of having a CB against which you can finance. We will make some photocopies of the material so you can see that later. The third thing that is very difficult to get right is dealing with management. For a lot of companies, if you have made an investment and the management is in place, it's very expensive, almost impossible to replace management because you lose time. You spend a ton of time dealing with the issues that arise from changing management. So you have to get it right. And the important thing is to not deal with people who are bad partners. If you deal with bad people like those crooks at Enron or WorldCom, you're the investor, your investment goes down to 0. I have some examples later on. But the first one is integrity challenged. The high achievers, on paper they look great. But in reality, when you deal with them, their high achievement has nothing to do with you as an investor. They may cheat you. They may really double deal you. So you don't want to deal with them at all. And there are some big company executives who grow up in the environment of big staff, expensive corner suites, and they cannot deal with in a startup environment. They fail. They come into a company with a few staff members and no support. They don't know what to do. They cannot deal with that. And then there are control freaks who cannot build a team. And we all know in today's environment, you need a team to manage a very complex business. If a guy is a control freak, you cannot change the nature of that manager. And then there are shareholders who may have a different agenda than you do. And alignment of interest. The common way of saying alignment is giving stock options. But we all know stock options don't actually do the trick, mainly because a lot of times stock options have no risk, and it can be manipulated. We know about the backdating issue a few years ago, when the stock goes down to this level, and management got stock awarded here. They say, oh, let's backdate it to this level so that we all make a lot of money. And the forward earnings part I talked about in the example of Asia Info. If you're projecting $5 million or $10 million earnings, you end up producing only $1 million. The investors are left holding the bag. You paid too much for the business. A couple of war stories. The first point about integrity, challenged high achievers. There's a company called Panqing Foods. Actually, I came up with the name because it was a company co-founded by me and my schoolmate from the school that Bolan mentioned, the Beijing Foreign Languages University. We had a program that trained translators for the United Nations, and this guy was in a class a year ahead of me. So he went to Geneva to become a simultaneous interpreter for the United Nations. From there, he went to the Fletcher School and then Harvard Law School. Got a JD from Harvard Law, joined Cleary Gottlieb on Wall Street as an M&A lawyer, then got headhunted by Pepsi to become a director for Asia and the CEO for Frito-Lay, North China. They did 2 years of market study on the snack foods market and decided that potato chips was the thing. The Chinese had very few things to munch on, and a billion consumers, if you could sell one bag of potato chips to half of them, you make a ton of money. So he was there for 2 years, came to me with the business case, and the study said, look, it's going to be a humongous growth opportunity. Why don't I do this? I quit with my team, which I assembled over the last 18 months. We've done all the study. We know what to do. And you give me the startup capital. Let's start a business. So we started a name called Panqing. And Warburg Pincus put up $6 million to own 80%. I was the chairman, he was the CEO. And then we went into production. 7 or 8 months later, I came to the Warburg Pincus headquarters in New York City with a box of potato chips. I was very proud. We had Chinese flavor, seafood, Sichuan hot and sour potato chips. Everybody was excited. Now we're in big time, right? Several months later, I had anonymous fax on my desk. Your CEO is moonlighting at a big company, getting double salary. Should we, as employees of Panqing Foods, all do the same? I was really worried. I said, so. Called Mr. So-and-so, the CEO, said, what is happening? Are you moonlighting at a different place? He said, no. I said, okay, let me look into it. Next day, another fax that named the company he was at and the position. I got on the phone with that company. I said, do you have so-and-so working at your company? They said, yeah, he's a senior vice president of marketing. I said, how long have you had him? 6 months. Turns out he was using 2 phones. One phone for Panqing Foods, one phone for this European white goods company. and he was shuttling back and forth. So I confronted him. I said, look, let's not make a big scene. Why don't you quit in a month and come back, and we'll let bygones be bygones. A month later, nothing. Another month went by. He said, we sat down. He said, really, I cannot quit because I have made obligations I have obligations to this company. So in the end, I had to convene a board meeting and announce that today's agenda is for Mr. So-and-so to resign. And whether you like it or not, you sign on this piece of paper. Later, I found out the guy, A, had outsized ambitions. He really wanted to own his own helicopter, his own private jet, and this he thought was too small. The European company was the way to go. Second was he was actually secretly, he had a wife and 2 kids in Hong Kong. He was secretly cohabiting with Miss Chengdu, which is a big city in Sichuan province. They were living together. And he had to finance that lifestyle with a second income. High achiever, but integrity challenged, right? Needless to say, I fired him. We tried to find a replacement. Didn't work. Got somebody else from his management team. The business failed. It cannot survive. The startup business cannot survive the shakeup of a top management team. We lost $6 million. The guy went on to 3 other businesses. Each of them, I ran into the owner, reported integrity problems. Gourmet Electronics. The owner, Mr. Wang Guangyu, was ranked by Forbes for 3 years in a row as the richest guy in China. Built a great business, but now he's sitting in jail. Overly ambitious, had a secret life, and had a take no prisoners approach. Let's see the performance. Great company. Look at the performance. Revenue triple. This is when we invested in the company. $2 billion to $6 billion in 2009 when we exited. CAGR 29% on revenue and 21% on net income. Market cap, look at this, $1 billion to $5 billion. What went wrong? We made the investment here. Stock went up 40% on the date of announcement. He sold $150 million. He acquired the 3rd largest electronics maker, consolidated his position. Stock went way up. He sold another $300 million. Bought the 4th largest company in the same business. And then he did a placement for, we didn't say how much. He did another placement for $300 million. What he did was, he was the chairman and the largest shareholder. By the Hong Kong Stock Exchange rules, you cannot sell shares without announcing to the public. He wanted to conceal that. So he announced a gift of 1 billion shares to his sister. A week later, his sister sold shares. And at the same time, the company was doing a buyback. So I was a director. I wasn't aware of it. And the SFC in Hong Kong launched an inquiry into this and tried to trace the company documents. We had a resolution, a board resolution. My name wasn't on it. I wasn't even informed that we were doing the buyback. So what happened to the money? He probably got, by my account, about $1 billion, put up $1 billion out of the company. And currently he's being charged for money laundering because he exchanged the money through illegal means to gamble in Macau. Reportedly, he lost $800 million gambling. And that's the use of proceeds. Okay. Alignment of interest. It's very difficult to get management to think like shareholders, and we need to get everybody in the same boat. And it's really difficult, and unless you have control, you cannot change management. And I have a few cases to go through, but mindful of the time, should we leave more time for questions?
It's up to you. We're looking up this.
Okay.
Yeah.
Okay. All right, one case. This is a company that we invested in 1995. Again, I was the chairman. I just by my own account, I fired 20 CEOs in my career in 20 years. And each one has a very interesting story. This is one of them. Oh, by the way, this is a company that I fired a CEO twice. It was a textile company. The blocks were New York Trader. And Mecox Lane, by the way, was a street on their block in their home somewhere in the New York metropolitan area. They were trading in China for a long time. They thought, ooh, in the US, you had all these mail order companies like, we are all familiar with Victoria's Secrets, Eddie Bauer. These are mail order companies. In China, nothing. So they said, oh, great idea, let's do that. They came to me, to Warburg Pincus in '96. They said, why don't you fund us? And we have a great manager called Werner Seiler. Werner Seiler was the executive vice president of Queller Schickendanz, which was at the time the second largest mail order company in the whole world. The largest is also a German company. And Werner decided to move to China to start this business. Very admirable. But he gave us a business plan that would require $7 million to build a $100 million business. 3 years later, we ended up investing $27 million, and the sales was only $10 million. What went wrong? He was German, Japanese, fluent in 6 or 7 different languages. When I asked him what the Chinese consumers wanted, he said they wanted what I can give them. He was very arrogant. So we had to fire him because after many seasons, every time he had an excuse. It was either the flooding of a city, or bad weather, or some strike. And at a board meeting, I got really upset with him. I said, you have all these excuses. Have you ever thought that the reason might be you? So he was gone. Next guy, Taiwanese guy. He's actually a dear friend, so maybe I should have just taken out the names. But he didn't work because he came from Taiwan, also from a big. Both these guys are big company guys. He came from China Everbride, a big conglomerate in China. Couldn't manage the business. When I let him go, we only had less than $1 million on the bank, and by his own account, about 21 days from bankruptcy. So at the time, it was actually interesting. He ended up in a good job. Walmart was looking for a China head of purchasing, and I was arranged to have a phone call with Lee Scott, the president at the time. So I recommended him. He ended up becoming the 4th or 5th highest ranking executive at Walmart, responsible for billions and billions of dollars of purchasing. And then we replaced him with a local guy by the name of Alfred Gu, who came from Bertelsmann, a direct marketing company, and a Shanghainese. So this is another lesson learned. You need a local guy to deal in a local business. So the story went down to, in the end, we sold the company for 25 times PE and $100 million cash. But we only got it right the 3rd time. It was a long 10-year investment, 12 years actually. I actually got tired of serving as its chairman. Department store, we invested, this is one of the largest department stores in China. After the IPO, they lost focus. It was on a tear, doing very well, but they started investing in real estate in unrelated businesses, and the CEO was, doing things that we thought were borderline. So we had to replace him, pull him back, even though we only owned, at the time of the investment, we owned 35%. Then, not today, we own 22%. And after we refocused the company, changed management, stock went back to a historic high. About 2 weeks ago, we did a block trade through Morgan Stanley. We sold down about $100 million worth of stock. So far, we've recouped $185 million on $87 million in investment. The remaining is stake is worth $350 million. And here you can see the financial performance and the stock price went up to this, and because of loss of focus, went back down, change management. It's a happy story. Not always easy because you have to persuade them to do this. This is the largest pharmaceutical company in China. When we invested in the company, the thesis was very simple. The market was growing at 15% a year, and most of the companies in the sector were state-owned. So we thought all we needed to do was just to grow with the market, and maybe cost-cutting, taking the low-hanging fruit. After making the investment, we discovered that the company's profit, as reported, was a result of negotiation. You go to management, we sit down with them, and you say, okay, we want you to produce 15% rate of return of profit growth for the next year. They said, okay, fine, you get it. Next year, same thing. It turns out that the company was actually a lot more profitable than we had thought. But they were all hiding the money in what they call little gold vault. They were just hiding the money so that they could benefit because of the agency problem. Management had no stake in the company. One egregious example was one of the subsidiaries had 1 year after we went in, we discovered they system-wide, 3,000 employees, year-end bonus, plasma TV, the size of half of this board. Every single employee got a bonus like that. Next year, including the drivers, they had something like 100 drivers, a fur coat as a year-end bonus. So shareholder money was wasted like that. And there was 1 year they were competing with a company in Shenzhen for advertising money. They were going to spend like $20 million in TV advertising. And they told, it was auction. They told the other company, unless you give us 6 Mercedes-Benzes, we will bid you. And we will make you pay a lot more. So that's the kind of mentality in a state-owned company. And in the end, what we did was look at the financial performance. We had to change the heads of all 6 subsidiaries to make this happen. Double the revenue, this is the US dollars, right? And quadruple the net income. This will not happen if you have entrenched management. And the interest is not aligned because of agency problem. The last one is very difficult, is doing the right thing, selling at the right time. Examples, Asian for the story I told. Our cost was $1.97. When it went public, $24 a share. First day of trading, opened at 95. Went up to 120. Biggest mistake I made was I didn't sell. After the lockup expired, it was still trading at $70 a share. Our stake, $11 million at cost, at the peak was $900 million, worth $900 million, and then went down to $400 million. I got emotionally attached to the management team, wanted to keep building the business. The problem was it was building the internet backbone. When that building was done, no more business. So they had to change their business model, reinvent themselves, which was a very hard thing to do. And we ended up selling here for 5 times our money as opposed to 20 times our money. So I learned my lesson. Next investment, we invested in the company here at $10.80 a share. In a few months, it went to $30 a share. I said, whoa, I learned my lesson at Asia Info, let's sell. Stock went down to reach a peak of $200 a share. We made $300 million from a $65 million investment at 700% IR. We could have made $1 billion. But 3 years later, went back down to our cost. And then it's going up. So capital markets, it's very, very hard, extremely hard to make the rational decision. At this point, we thought it was already overvalued. Went on. So it's like the internet bubble. You never know when the bubble would burst. Next investment, Greentown, a real estate company. This time I said, okay, R&F, same business, same industry, same market, both listed in Hong Kong. So we said, okay, it went from $10 a share to $19 a share. We said, let's hold on because RNF went up to $200 a share. Never saw that. Went down to $2 a share. So one case selling too late, one case selling too early. This one we haven't even sold. Huiyan Juice, we decided to sell after the IPO. This is after the IPO, 2007, when the indicators all reached negative territories. And we had a problem. At that time, if you remember, at the Olympics, the French president, Sarkozy, announced that he was going to boycott the Olympics, the Beijing Olympics, because of what was happening in Tibet. And there was nationalism against France. We, unfortunately, at Huiyan Juice had Danone as a 20% shareholder. So the owner wanted to get rid of Danone. But Danone didn't want to sell. And we got caught in the middle. I saw those numbers. I said, the company should be sold. So Danone said, we cannot sell. And the majority shareholder who owns 50% says, what if you buy me out if you don't want to sell? Danone said, no, we can't buy. So we're stuck. The only solution was to sell a third party. So we signed a secret agreement to sell the company to either red or blue. And we ended up selling to nobody. The company is still there, by the way, Huiyan Juice. Performance is slightly better, but not much. Look at the stock chart. Invested here, try to persuade them to sell, announcement, and then the deal got killed. We got out this, and because of the deal structure, we were guaranteed 15% IR. We got out okay, but not great. Would have been better if red or blue could have bought the company. Now, very quickly about private equity as a career, I think it's the best job in the world because in the morning, you go into the office, you actually have a blank sheet of paper, you hang up your coat, you can decide what you want to do. You can invest in the steel industry, you can invest in the auto industry, you can invest into the potato chips industry. And it's a great business model because you make money, it's 80-20 split, as you know, what we call carried interest. If the investors make money, you get 20% of the cut. Where else can you find a business where you don't have to put up any money or even 1% of the fund, and you get 20% of profit? And instead of like a lawyer or a banker where you get called and you're on call 24 hours a day, you don't have a client. You are the client as a private equity investor. You at the top of the food chain. You find transactions, you find bankers to structure for you, to sell it for you, you have lawyers to write documentation, you have accountants to do accounts for you. So I think it's a great business where results count. And there's never a dull day. Just the stories I told you, I can tell you, for the next 100 days. So many different stories. Very, very interesting because every day there's something happening. And best of all, it's a lifelong learning process because everything I've learned in my life, IQ, EQ, you name it, you need to use it because you're dealing with people's psychology, you're dealing with real life situations, you're dealing with capital markets, and you never learn enough. If you ask me what you need to do to prepare yourself for a career, go through this list, and it's simple. I don't want to elaborate on it. Judgment, obviously, is the key. Judgment of people, judgment of timing, judgment of businesses, and micro and macro issues. It's a small industry, not easy to get into. 1995, when I started, 47 firms, and today 600 firms. But look at the number of employees. Only from professionals. This is the US, from 4,800 to only 6,000. This is the entire United States. So it's a very small industry. I have the stats here. 2000, the hiring of MBAs. This is the top 20 private equity firms. Total number of hires, worldwide, 40. US MBA hires, 30. And we hired 6 people. We're the second largest employer. The largest is Bain at 8 worldwide. In the US, Bain Capital hired 5 this year. We hired 3. So it's a difficult industry to get into because it's small, but the amount of capital under management is humongous. Worldwide, it's over $1 trillion. Think about it. The U.S. economy GDP is only 14 trillion. It's a huge amount of buying power, concentrated in a few people. And just this is total number of employees. The number of partners is much smaller. They make decisions. Remember that. And a little bit about the firm. Warburg Pincus is one of the oldest private equity firms and one of the largest, founded in 1966, and a global firm. We started in Europe in 1986 and in China and India in 1994, 95. And we have about $42 billion of investment, total capital invested. 20 minutes for Q&A. Thank you. Anyone?
We're open for questions.
Chang, I've been following the rise of the local currency RMB funds in China with some interest. I was curious as to whether Warburg has plans to raise an RMB fund and what you sort of see as the advantages and disadvantages.
We certainly do, because it's not because it's fashionable. It's because it's an inevitable trend. If you think about it, would you invest, British pound sterling in the United States? Probably not. The natural thing is invest in dollars in the United States. So the natural thing in China to do is to invest RMB in China, and also because the social welfare funds and other pension funds in China are swelling up. They're trying to find an outlet. We are investors. Whether money comes from China or the United States, it doesn't matter. We need to find good opportunities for capital appreciation. So we have to do that, and it's a question of when.
Can you give us your thoughts on how private equity should approach privatization deals in the emerging markets? You mentioned Warburg Pharmaceutical. I don't know whether you...
Warburg Pharmaceutical is a privatization. We believe that actually privatizations are very, very interesting. They could be very profitable. We did a privatization deal in the Czech Republic in a company called Zentiva. It was a pharmaceutical company that the state was running. It wasn't profitable. We bought 100% change management, gave them the right incentive, and made almost $700 million out of the transaction. So it can be very profitable, but it can be very political because there are so many government agencies involved. It takes a long time. It's a lengthy process, and you need to have the right mindset. But I would say privatizations are very interesting. And if you have the right angle, they can provide very good returns.
So you mentioned the Chinese government's involvement in the juice company transaction. And I asked a version of this question last week when we were talking to a Middle Eastern investor. But how do you price in that political risk going forward in your deals where you're either you're contemplating an exit or you somehow have to take a stance on how important that kind of an issue could be?
I don't think you can price it against it. You can structure against it. So for example, if you have a put option or you have a IR guarantee, then you can get out. But pricing this into other deals is very difficult because entrepreneurs don't want to be unnecessarily penalized for one decision in an isolated case.
To that point, when you structure a put option, are they fairly enforceable in regions of Asia, and are there some countries where it's less likely to be enforceable with a put option or an exit right?
It's like taking a credit risk. It's very difficult because if you want to be enforceable, you want assets against the put option. It's very difficult, and we've never tested in court. I would actually think about it, when I talk about it internally, I describe it as a nuclear deterrent as opposed to actual enforcement. So you have this in your hand, you're using this to force things to happen. So you never drop the nuclear bomb, but if you have the nuclear deterrent, you can force the other party to come to terms. And it's a way for you to force a sale to happen. In the case of Huiyan Juice, because we can threaten that we want to exercise the put, he doesn't have the money, what do we do? You can sell the company. Otherwise, as a 10% shareholder, we have no way of effecting a sale.
You mentioned that like mega trends are driving the investment return, and they're like one of the most important drivers in like your strategy. What kind of mega trends do you see are coming in the U.S. and like China in the next 10 years, and which industries should you look at?
In the U.S., I think there's a paradigm shift in the energy world. Everybody has to rethink how they use energy, how they pay for energy. So a ton of VC money has been invested into solar, into biofuels, into thermal power. So that's a game-changing event that will happen. But the issue is really how you play it. We've seen a lot of people losing money investing into internet-style bubbles that would yield no return. The other one is the financial services industry in the US. There will be, again, a paradigm shift with the investment banks becoming bank holding companies, private equity firms being sort of spun off because of the new regulations, the VOCA rules, and so on and so forth. Whenever you have seismic changes like that, you will have opportunities for private equity. What we hate most is status quo. If there's no change, there's no opportunity for us. Same is true of China. You think about China. The other mega trends I didn't mention are like aging of the society. China will have a lot more people over 60, retired people, before they reach sort of middle income in that sense. They don't have enough money to pay for the retirees. So think about the implications for the aging of the society. Environmental degradation is another mega trend. The environment in China, you all know, pollution is horrible, and source of water, and land, air. What do you do with that? You want to maintain the kind of industrial growth you've been having for the last 10 years, at the same time not polluting the whole world with your industrialization. So new technologies that help manage the pollution problem will be quite interesting. Waste management connected with that. So mega trends, you think about things that would affect our lives, affect the economy, affect the entire society for the next 10, 20 years, will create investment opportunities. So our business, private equity business, is a thinking business. It's consulting plus investment banking plus management. That's why it's so exciting.
From what I understand, Chinese business requires a lot of relationships and having the right connections. I guess, how did you overcome those difficulties when you started out the East Asian division?
I think when you say relationships, people automatically think corruption. I personally think that relationships are becoming less and less important in a country that is becoming more and more open. Remember, corruption only happens when you have secrets, when you have concentrated power, when you have no transparency. So at Warburg, we are a US firm, just like KKR and Bain. We're subject to what we call FCPA, the Foreign Corrupt Practices Act. You cannot do anything to influence government officials through advantages like money or anything else. So we do not believe that relationships are key to our success. On the other hand, the companies we invest in must know how to navigate government relationships, must know how to deal with governments, because after all, China is still a not market economy yet. It's still a centrally planned economy. So it's a delicate balance. But I think the key success factor, remember I had a slide up there, no relationship. It's other things, identifying the mega trends, dealing with management, aligning the interest, and and selling at the right time, not relationship. That's not top of my list.
Let's say there's a very attractive company with huge potential, but the entrepreneur is not willing to share the upside, so they don't want to sell the equity. Is there anything you can do in terms of structuring the deal or approaching the entrepreneur to get involved in this development?
We run into companies all the time who claim that they don't need equity. I don't think so. Unless you're Microsoft, you're generating 35% net margin and a pile of cash. If you're growing at above market rate, at some point you need financing. But it may not be us, because private equity is the most expensive form of financing. The cheapest, obviously, is bank loans. Then you go up to sort of mezzanine debt, you go into hybrid debt, and then you go into other things like going public, and private equity is the most expensive form. So there will be a segment of the market that would not want our money. So the best thing you can do in a situation like that is to make friends with them, keep staying close to them, hoping that they will need you for reasons other than money. For example, we have invested in 2 companies that did not need money at all. Harbin Pharmaceutical, the company I just mentioned, never used the money. We gave them a total of $250 million. They actually paid dividends. Their cash today is $500 million on the balance sheet. Never used the money. Why did they need us? They needed us to be a change catalyst for change. They needed us to be a change agent, to change the culture of the company, to change the incentive structure. And therefore, the company financial performance can go up. The other company, the other example is a company called LaPu, which is a medical devices company that makes stents for, if you have a heart problem, the traditional way of doing this is to have a bypass. New technology invented in the US and perfected around the world is to have a stent that would try to unclog the arteries. So this company makes that. We invested in 2006 when the company actually didn't need money at all. What they needed was they had a state-owned shareholder, and the entrepreneur was having problems with the shareholder, like giving stock options and so on. The state-owned shareholder didn't want to give stock options. So they wanted to broaden the shareholder base. We stayed close with the company and persuaded the shareholders to take our money. We invested $20 million for 20%. They never used the money. They actually paid us $9 million of dividend. So our cost went down, and then we gave them another $7 million for acquisitions. The company went public October last year in 2009. Our $20 million today at cost around 17 is valued today at $500 million. But they never used the money. So the best companies are actually companies like that. They come to you for a reason other than raising capital, like improving governance, creating the right incentive structure. If a company that's desperately in need of money, you have to think twice.
Can you talk about how Warburg as a firm thinks about allocating capital? So obviously you invest around the world, you invest in developed economies, emerging economies, which have different risk profiles. Do they require different equity returns in order to justify a return in China versus return in the US? And how does the firm think about that?
No, the short answer is we do not try to risk adjust returns around the world. You know why? You can never justify an investment if you do that. How do you price political risk in China or currency risk in China? What we do is we, again, use a top-down macro approach. We look at where the growth is from, because private equity essentially is a growth business. Unless you're in buyout, that's different. You use leverage. So if the growth in China is 11% to 10% and the US is 2%, the answer is quite obvious. But you may not be able to allocate all your money in China because, like a question here, a lot of the entrepreneurs don't want your money. So you have to balance the need for capital against the desire for capital. And as a firm, we have what we call executive management group, which is a management committee. I sit on that committee, and we're about a dozen people who run either a geography or industry. And we sit there around and we talk about investments. And we have a rough allocation in mind, but it's never set in stone. And it's sort of first come first. Everybody surfaces their best deals to the committee. Then we decide which deals have the best return profile adjusted against risk. So it's never a fixed formula. It's more like a field. This business is a field business.
Do you think Warburg, like you being part of a global firm, gives you a distinct advantage doing deals in China? Or do you think that's not really an advantage as against the local PE firms?
It's both. Actually, it's a double-edged sword. On the one hand, we have the global franchise. Like if we do a alternative energy deal in China, we have the research team in the US that give us the technology, the data. For example, we just made an $80 million investment in a company that collects gas, drills for sort of gas in a coal mine. And it's a very technical business. Unless we have the global expertise in New York, we wouldn't have done the deal. On the other hand, the local firms make much quicker decisions. They don't have to go through the global chain. They can promise to the entrepreneur on the ground, tomorrow I'll fund you. So it's a double-edged sword, but I think if you look at this in totality, as a global firm, I think we do have an advantage because of the 40 years of experience, because of the resources that we can bring to bear on a particular deal. See here? There was a hand up there. No?
I'll ask you another one. How do you manage the IP risk, intellectual property risk?
You have to do due diligence. There's no other way. I saw a ton of proposals on biotech. Then we discovered that more or less they were all trying to reverse engineer the US ideas. You can't even touch that. So the only way to do that is to do diligence over and over again to make sure you're not stepping on people's toes.
I noticed that at least in the cases that you provided, a lot of it is domestic, say Chinese companies serving domestic markets. I was wondering if that's just the cases you chose, or if you find something better about Chinese companies serving Chinese markets versus sort of companies that are making plays into China, or Chinese companies that sort of serve more international markets.
As a mega trend, I think Chinese companies exporting to the US is a great proposition for the US consumer, a terrible money-losing proposition for the investors. You know why? Because the RMB is rising. So your costs are denominated in the RMB, and your revenues are denominated in the US dollar. And then you have Walmart and Kmart and Sears as your customers who are concentrated and extremely powerful. They're pushing you to cut down costs so they can offer everyday low price. So it's a terrible combination for export-oriented businesses. That's why we focus on domestic consumption businesses as opposed to export businesses, because it's a macro-wise, it's not a great thesis.
Culturally, how are the local shareholders welcoming to an international firm, international perspective? Does that help you as a change agent, or is it kind of get in your way? How does it play out?
I'd say they are divided into several groups. One group, the most open and the most ambitious group, want to be among the best. They want to compete with the best in the West, and they want you to help them get there. And they want, for example, we just had the China Merchants Bank president here who's making a speech elsewhere at the same time. They want to come to Wharton. They want to learn. And that's the best kind of entrepreneur you want to align yourselves with. You want to invest in them. The second kind wants your money and wants you to go away. Give me your money and leave me alone. I'll make you returns, fine, but it's very difficult to work with them, and we don't want to work with people who don't welcome our involvement. And the last kind are the local guys who are slippery, the integrity challenged achievers, high achievers. They can do a lot, but they will never change their behavior. They may be slippery, they may be offering bribes. They are successful. They are they can make a ton of money, but they're crooks.
So what is the most important point when you have for the candidate? If you have a job interview with the candidate, you guys?
one sentence, learn as much as you can. But to be more specific, I think our industry, private equity industry, is still a subset of the finance world, the finance sector. So you have to learn the finance 101. I think just looking at the people we've hired over the last 20 years, people who have consulting backgrounds, who have banking backgrounds with some operating exposure are the best because they think strategically. They can offer financial advice. Remember, we have to deal with the entrepreneurs who will not respect you unless you have something to add. But you will never be as good as they are in their industry because they live and die in that industry. So you have to know something about finance, about financial markets, about instruments, about the fancy stuff, about M&A, so that you can add value. And that's the only way you can gain respect. And once you have their respect, you are on the same terms with them. You can discuss and come to terms with them on important decisions, which are key for the success of an investment. Thank you.
Thank you very much.